The important thing is Vanguard's going to be releasing its global economic outlook, its 2019 economic outlook next week, but we've got a preview for you. We've got Greg Davis here to talk about that. We just want to note, Larry Kudlow said the president was open to a trade deal at the G20 meeting. We saw the market rally on that. You have your number one risk factor, trade tensions, along with greater expectations of tightening by the Fed. Suppose we do get some trade deal here. What's going to be the effect on the markets?
I think what you'll see is this dark cloud that's lifted off the market from an uncertainty standpoint, right? There's been this uncertainty that's been overhanging the market because of this trade tension, and it's had an impact in terms of widening credit spreads on the corporate side, high yield spreads, and it's also put a depressing factor on in terms of equity returns and things of that nature. So it's been a bit of an overhang.
Now, you also said your second great risk is the Fed overly aggressively tightening.
Right.
But you think they're going to stop near 3%.
We do.
That's what you said in the report. Now, but that's still 75 to 100 basis points more. There's a lot of people who are arguing on our air saying December they should stop. One more and that's done. Was there something wrong with that theory?
Look, you have a labor market that's still unbelievably tight. You have an unemployment rate that's at 3.7%, which is below the low that we saw 30 years ago. And so the labor market, in terms of tightness, in terms of earnings growth, those types of things are still relatively strong. And so we think that the Fed still has the ammunition, unless something else breaks in the system or the economy, that the Fed is going to continue on its path of gradually tightening interest rates.
The market's trading like the earnings growth expectations for next year are going to be much lower. The analysts are expecting 10% earnings growth in 2019, yet the market's acting like there's only going to be 3, 4, maybe 0% earnings growth. What's your viewpoint?
Our viewpoint is that, look, we're going to get solid earnings growth over the next 12 months or so, but after that point in time, you're going to start to see that the benefits of the tax cuts that we've seen in the economy are going to start to diminish, and you're going to basically see, basically standard economic growth being the primary driver of what we see in terms of equity market earnings growth. So it is going to slow down.
Yeah, you're talking about 2% GDP, right?
That's correct, for the U.S. Trend growth.
China about 6%.
Right.
Equity market returns, you made a big point about this a little earlier. Expect lower returns in the next several years now. Now, I know we've had some pretty good returns in the last 5 or 6 years, but why should we be positioned for lower returns? You didn't say negative, you just said lower than we've been seeing.
If we look at what our expectations are on a median basis for the next 10 years in the U.S. market, we're expecting returns in the neighborhood of about 4% for the U.S. equity market. When you look at the international equity market, we're expecting returns that are going to be closer to 7.5% or so. And so there's a big delta between those two, and it's primarily driven by two reasons. One, equity market valuations in the U.S. are elevated relative to the rest of the world, and we're much further along when it comes to where we are from a monetary tightening standpoint. So those two factors are leading drivers of what our expectations are around equity market returns going forward.
But you've stated, I've talked to you before, there's no you don't see any recession in
Not in the near term, no.
Okay.
No.
So we're not talking about any bear market, because bear markets come when either the Fed gets really ridiculously aggressive or there's a recession,
Correct.
Right? So you're not anticipating any kind of bear market.
We are not, but if you get to the point of late next year where the Fed starts to become restrictive, you're getting closer and closer to a point where the risk of a recession starts to increase. So we'd say that probability is going to start to rise in early 2020 and mid-2020.
How about sectors? Value versus growth, international versus U.S. Any advice for U.S. investors?
For U.S. investors, it's say, look, go back and take a look at what's happened over the course of the last 5 years or so. And so when you think about the fact that the U.S. equity market has returned about 10% over that time period annualized, and you look at the international equity markets returning about 2%, there's been a lot of movement in overweight to U.S. equity just by the natural growth.
We've got to let you go, but last question, 10 seconds.
Sure.
High yield. A lot of our viewers are invested in high yield. Your thoughts?
High yield, look, again, high yield spreads have widened out substantially throughout the year, about 80 basis points or so, but we still think that there's a lot of risk in high yield, especially if the Fed's tightening interest rates.
Greg Davis.
So be cautious.